Something just changed. And I'm not talking about price action. I'm not talking about a tweet from a billionaire or a headline from a network that's always 4 days late. I'm talking about three completely separate, completely independent things that just aligned at the exact same moment in time. One in regulation, one in infrastructure, one in capital. And individually, they're easy to dismiss. But together they form a picture that most people in this space have never actually seen before. Not because it's hidden exactly, but because you have to know what to look for. And here's what makes this different from the usual crypto noise. The last time a setup like this came together, regulation, infrastructure, and capital moving in the same direction at the same time, markets didn't just drift higher, they repriced violently and fast. So before you scroll past this, before you assume this is just another hype cycle, stay with me through the first 5 minutes. Because what I'm about to walk you through isn't about price targets. It's about understanding a structural shift that is already underway. And by the time most people realize what happened, it may already be over. Quick note before we go deep, this is not financial advice. Everything here is for informational and educational purposes only. Always do your own research and consult a professional before making any financial decisions. Now let's get into it. Here's the thing about big moves in any market. They never announce themselves. They don't come with a bell. They don't come with a ticker alert. They don't trend on social media the morning they begin. They build quietly, piece by piece, layer by layer. And by the time they become obvious, the opportunity is already in the rear view. Now you might be seeing fragments of this story already. A regulatory update here, an approval buried in a government press release there, some quiet movement in capital flows somewhere in the background. But each piece standing alone looks small. It looks like noise, and that's exactly what makes this moment so easy to miss. Because this isn't one catalyst. It's not one headline. It's not one tweet or one ETF approval or one famous name dropping a bag. This is three separate systems, regulation, infrastructure, and capital, all moving in the same direction at the same time. And when that happens, that's not noise, that's signal. So here's what we're going to do today. I'm going to break down each of these three moves in detail. I'm going to show you exactly why each one matters individually. And then I'm going to show you what it looks like when all three of them connect. Stay with me until the 17-minute mark, because what I lay out there is the piece that actually changes how you think about what crypto is becoming and who is going to control it. That part matters more than anything else I'll say today. Let's start from the beginning. Let's talk about the thing that most people scrolled right past, the Clarity Act. Officially, it's the Digital Asset Market Clarity Act. And if you read the headlines when it first came up, you probably filed it under government stuff, complicated, not relevant to my portfolio. Wrong. This law, or more precisely, the regulatory direction it represents, is arguably the single most important structural shift that has ever happened to the crypto market. And here's why. For over a decade, crypto has had one fundamental problem. Not price, not volatility, not even adoption. Uncertainty. Specifically, regulatory uncertainty. And I want you to understand what that actually means at the institutional level, because it's not what most retail investors think. When you or I look at crypto, we think about charts, we think about narratives, we think about which coins have momentum and which ones are dying. But when an institution, a pension fund, a sovereign wealth fund, a major asset manager sitting on hundreds of billions, when they look at crypto, the first question isn't, will this go up? The first question is, can we legally hold this? If we hold it, what rules apply? If something goes wrong, who is liable? If a regulator comes after us, how do we defend ourselves? And for years, 10 years, the answer to all of those questions was, we don't know. Not fully, not clearly, not in a way that a compliance team and a legal team and a board of directors could sign off on. And that uncertainty, that ambiguity, was a wall, a real structural wall that kept trillions of dollars sitting on the sidelines, not because institutions didn't want exposure to crypto, but because unclear rules mean legal risk, compliance risk, reputational risk, and no fund manager in the world is going to risk their career, their firm's reputation, and a potential SEC investigation for an asset class where the rules aren't written yet. Now here's where things start to get interesting. That wall is cracking. And to understand how significant that crack is, you have to understand how long it's been building. Think back to 2017. The SEC starts calling ICOs securities. Exchanges start getting subpoenas. Projects dissolve overnight. Nobody knows the rules because there are no rules, just enforcement actions applied selectively and without clear precedent. 22. One of the largest exchanges in history collapses overnight. Regulators use it as a mandate for crackdowns, but still without a clear legislative framework. It's enforcement without codification. 23 and 24. Legal battles at the highest levels. Coinbase itself fighting the SEC, asking a federal court to force the agency to issue clear rules. Think about that. An exchange having to sue a regulator just to get clarity on what the rules even are. That is the environment this industry has been operating in. That is the uncertainty that has kept institutional capital out. And now, after years of legal battles, failed bills, political gridlock, and industry lobbying, a framework is taking shape. Because what the Clarity Act represents, what this whole regulatory shift represents, is the beginning of a clear, codified, enforceable framework. A framework that tells institutions, here are the rules. Here's what's a security. Here's what's a commodity. Here's who regulates what. Here's how you stay compliant. And Coinbase, one of the largest and most regulated crypto platforms in the world, has been at the center of this. They've been navigating these legal battles, these regulatory engagements, these framework negotiations for years. And now the framework is starting to land. Now think about what that means in practice, because this is the curiosity loop that most people aren't closing. If regulatory clarity is finally arriving, if the wall that has kept institutional capital on the sidelines is genuinely beginning to crack, then what happens when trillions of dollars that had no reason to enter suddenly have every reason to? What happens to an asset class that was priced without that capital when that capital starts to arrive? Hold that thought, because it connects to everything that comes next. But I also want to be direct about something here, because this channel doesn't do hype without nuance. Regulatory clarity is not the same as regulatory freedom, and that distinction matters. Because a clearer framework also means a more controlled environment. It means more oversight, more reporting requirements, more KYC, more compliance. The same clarity that lets institutions in also gives regulators a stronger grip on the system. And that tension, opportunity on one side, control on the other, is exactly what part 5 of this video is about. So don't skip ahead. But first, let's move to the second signal. Because this one is where things get genuinely serious. Comment below if you've been paying attention to the regulatory side of crypto and whether you think it's net positive or net negative for the space. I read every comment on this channel, and I want to know where you actually stand. Let me ask you a question. What actually makes a financial market function? Not the prices, not the charts, not the narratives, the plumbing, the invisible infrastructure underneath it, all that makes every trade actually settle, every position actually transfer, every contract actually enforce. In traditional finance, that invisible layer has a name. Clearinghouses, and the approval that just happened, a Gemini affiliate receiving recognition as a derivatives clearing organization from the Commodity Futures Trading Commission, is one of the most structurally significant events this space has seen, and almost nobody talked about it properly. So let me explain what clearing actually is, because this isn't boring infrastructure, this is power. And before I explain it, let me put this approval in context, because the reaction most people had tells you everything about how much it's being underestimated. Most people heard CFTC Derivatives Clearing Organization and moved on in 8 seconds, because it sounds like bureaucracy, a checkbox, something that matters to compliance officers and nobody else. But here's what you actually need to know. The Commodity Futures Trading Commission oversees CME Group, the exchange behind more than 1 billion contracts traded annually across interest rates, equities, energy, and commodities. This is not a niche regulator. It is one of the most powerful financial oversight bodies in the world. And a Gemini affiliate just received formal recognition from that same body as a derivatives clearing organization. That means the crypto derivatives market now has a federally recognized clearinghouse with the legal standing, institutional credibility, and regulatory backing to serve professional participants at scale. And that changes the risk calculus for every institution that was waiting for exactly this kind of validation before entering. Now let me explain what clearing actually means in practice. When you execute a trade, any trade, there's a moment between when you agree on a price and when the assets actually change hands. That gap is where risk lives. What if the counterparty defaults? What if the trade fails to settle? What if conditions change between execution and delivery? A clearinghouse steps into that gap. It becomes the buyer to every seller and the seller to every buyer. It manages the risk. It guarantees settlement. It decides who gets access to the system. It sets margin requirements. It controls the rules of engagement for every trade that flows through it. In traditional finance, clearinghouses are not just infrastructure. They are the system. The Chicago Mercantile Exchange's clearinghouse, the Depository Trust and Clearing Corporation. These are the entities that sit at the center of global financial markets and, in many ways, determine how those markets actually function. And now, crypto is building that same layer. A Gemini affiliate, recognized by the CFTC as a derivatives clearing organization. That is not a small thing. That is crypto crossing from alternative asset class operating outside the system into legitimate participant in the regulated financial infrastructure. And here's the part nobody is paying attention to. When you combine clearing with execution and custody, you're not just participating in a market anymore, you're running it. Think about what Coinbase already controls: a massive retail and institutional trading platform, a custodial infrastructure used by some of the largest ETF issuers in the world, regulatory engagement at the highest levels. Think about what Gemini just added: a derivatives clearing function recognized by a federal regulator. Now think about what this means when these pieces connect across the industry: execution, custody, clearing. That is the complete stack of financial market infrastructure. And crypto firms are building it, piece by piece, under regulatory oversight. Which means, and this is the part I want you to really sit with, the question is no longer whether crypto will be integrated into the financial system. The question is, who controls crypto once it is? And right now, that answer is being written. Like if this is starting to make sense. Because this is the layer that separates people who understand what's actually happening from people who are just trading price action. Now let's talk about the fuel. Because regulation creates the framework, infrastructure creates the system. But capital? Capital is what actually makes a market move. And this is where the third signal comes in. What happens next is the real story. Wall Street just rotated roughly $292 billion back into risk-on assets. No screaming headline, no front page, no trending tweet. Just quiet, disciplined institutional repositioning. And I want to explain why this number matters, and why the timing of it matters even more. First, let's talk about what risk-on actually means in practice. Capital in global markets is always moving somewhere. When institutions get defensive, they move into bonds, cash equivalents, gold, and other safe havens. When they get aggressive, they move into equities, growth assets, emerging markets, and yes, eventually crypto. The shift between those two modes is one of the most reliable indicators of where markets are heading. Not because institutions are always right, but because institutions move enough capital to actually create the conditions they're predicting. They're not just forecasting the market, they're making it. Now, $292 billion. To put that in perspective, that is larger than the GDP of most countries on Earth. That is not a marginal reallocation, that is a structural rotation. And the sectors where that capital has been flowing tell a specific story. We're seeing it in large cap technology. We're seeing it in growth equities that had been beaten down in more cautious environments. We're seeing it in markets that are sensitive to rate expectations, because the macro environment has shifted enough that institutions are willing to take on duration risk again. This is what a genuine risk-on rotation looks like. And what matters for crypto specifically is the sequence. Crypto doesn't lead this rotation. Crypto follows it. The typical sequence goes like this. Risk appetite returns to large cap equities first. Then it moves into growth and tech. Then it moves into more speculative growth plays. And eventually, with a lag, it flows into digital assets, which means if the rotation has already happened at the institutional level in equities and growth assets, crypto may not be early in the cycle. Crypto may be the next domino. And here's what makes the timing even more significant. In previous cycles, crypto's lag behind institutional equity rotation was anywhere from several weeks to several months. And in every case, the people who had positioned during the lag before the headlines confirmed it captured the bulk of the move. The people who waited for confirmation, they got in at the top. Now that lag is potentially compressing, because the infrastructure to move institutional capital into crypto is better today than it has ever been. The custody solutions are more robust. The ETF vehicles are more accessible. The clearing mechanisms, as we just discussed, are being formalized, which means the time between institutional capital going risk on and that capital actually flowing into digital assets could be shorter in this cycle than it's been in any previous one. If that's true, if the window is narrower, then the window to act is also narrower. And if the $292 billion has already moved upstream, we might be sitting inside that window right now. Are you positioned or just watching? Drop that in the comments. I genuinely want to know. No judgment either way. But this is the question that actually matters right now. Now, I want to be careful here because I run this channel a certain way. This is not a prediction. Capital rotation happens in phases and timing is never clean. Markets can stay irrational longer than most people can stay solvent. That's still true. And $292 billion rotating risk on does not guarantee that crypto captures any of it. But here's what is undeniable. The conditions that historically precede major moves in digital assets are forming. Not all at once, not with a neon sign over them, but they're forming. Regulatory clarity, reducing the wall for institutional entry, market infrastructure being built that makes institutional grade participation possible, capital appetite rotating back toward risk. One of those, interesting. Two of those, noteworthy. All three, simultaneously, that's rare. And this is exactly why this moment matters right now. Subscribe if you want to stay ahead of what's coming, because the next shift in this story is already in motion, and this channel is where we track it before it becomes obvious. Let's zoom out. 3 signals. 1, regulatory clarity. The framework that has kept institutional capital out is beginning to solidify. The rules are being written. The uncertainty, the real barrier, is starting to fall. 2, infrastructure. A Gemini affiliate just became a CFTC recognized derivatives clearing organization. Combined with a custody and execution infrastructure already in place across the industry, crypto now has, or is rapidly building, the complete institutional grade stack. 3, liquidity. Roughly $292 billion has quietly rotated back into risk-on positioning at the institutional level. Historically, crypto follows this kind of capital rotation, not leads it. Now here's the thing about alignment. These 3 layers, regulation, infrastructure, and capital, operate on completely different timelines and are driven by completely different actors. Regulatory changes are driven by legislators, regulators, and legal battles fought over years. Infrastructure changes are driven by firms making long-term strategic bets on what the financial system will look like in the future. Capital allocation changes are driven by macro signals, rate environments, risk appetite cycles. For any one of them to shift is notable. For all 3 to shift in the same direction at the same time, that's not a coincidence, that's convergence. And in markets, convergence like this is rare. It's also, historically, what creates the conditions for the kind of repricing that people talk about for years afterward. Not slow drift, repricing. Because think about what's been priced in until now, a market where institutions can't cleanly participate, where the infrastructure is fragmented and risky, and where liquidity is moving away from risk. What happens to that pricing? When all 3 of those things change at once, what would you do if this actually plays out the way the structure suggests it might? Drop your answer in the comments. I want to see how people are actually thinking about this. And if you found this breakdown useful, share it with someone who needs to see it before it's too late. Not because of the usual reasons, but because this is genuinely a moment where being a week early and being a week late are 2 completely different outcomes. Now, here's where I have to be honest with you. Because there's a twist to all of this, and it's the part that makes this whole picture more complicated than a simple bull case. Everything I've laid out up to this point sounds bullish. And structurally, it is. But here's the question I want you to sit with. Is crypto becoming stronger, or is it becoming absorbed? Because think about what we've actually described in this video. We've described a regulatory framework that defines the rules written by governments and enforced by federal agencies. We've described clearing infrastructure that creates a centralized layer at the heart of crypto markets, controlled by firms that are themselves under regulatory oversight. We've described institutional capital flowing in, capital that comes with requirements, reporting requirements, compliance requirements, liquidity requirements. And here's the tension. Every one of those things that makes crypto more accessible, more legitimate, more valuable in the short term also makes it more like the system it was designed to challenge. Bitcoin's white paper was written in response to a financial crisis. It was a proposal for a system without trusted intermediaries, without clearinghouses, without regulators determining who gets access and who doesn't. And now, 15 years later, we are watching the very infrastructure that crypto was meant to make obsolete become the infrastructure of crypto itself. Is that a failure of the original vision? Or is it an inevitable evolution of any technology that goes mainstream? I don't think there's a clean answer, and I'm not going to pretend there is. What I'll tell you is this. The opportunity is real. The structural shift is real. The capital flows are real. But the crypto that comes out the other side of this alignment is probably not the crypto that early believers imagined. It will be more accessible, more regulated, more integrated, and also more controlled. Do you think the system can hold? Can decentralized values survive institutional integration? Drop your take in the comments. This is the question that defines the next decade for this space. And I want to hear how people on this channel think about it. So here's where we stand. A regulatory framework, the Clarity Act and everything surrounding it, is reducing the single biggest barrier to institutional participation in crypto markets. A derivatives clearing approval, a Gemini affiliate recognized by the CFTC, signals that the institutional-grade infrastructure layer of crypto is not coming. It's here. And roughly $292 billion in institutional capital has quietly rotated back into risk-on positioning, the kind of upstream capital movement that, historically, precedes significant moves in digital assets. 3 signals, 1 direction, and a structural setup that, in my years of watching these markets, I can count the number of times I've seen it on one hand. Now, here's the only question that matters. When the market finally prices in what's already happening underneath the surface, will you understand what you're seeing? Or will you be watching the chart move and not know why? Because knowing why is the difference between reacting and being positioned. This channel exists to help you understand why. Before the headlines, before the obvious, before it's already too late to act on it. If you've been watching for a while and this breakdown finally made the full picture click, do me a favor and drop the word clarity in the comments. I'm tracking which topics are resonating most, and that'll be my signal to know where to go deeper. And I want to know, what do you think the next major move in this space looks like? What should we cover next? Drop your suggestion in the comments. The next video might be built around what you tell me today. If you're not subscribed, now is the time. Hit the subscribe button and turn on notifications. Because what's building in the background right now moves fast when it moves. Share this with one person who needs to understand what's happening before it happens. And I'll see you in the next one. Because what's coming next might be even bigger than this.